Revenue can look steady on the surface, yet the economics beneath can shift dramatically. Concepcion Industrial Corp started the year with warehouses full, carrying more inventory, even as Philippine consumers pulled back. Sales of goods slipped 5% to 8.93 billion pesos in the first half, driven by softer demand for air conditioners and select refrigeration products. However, finished goods and in-transit inventory surged nearly 29% from the end of December, tying up more of CIC's cash and products waiting to reach customers. This buildup reflects earlier orders intended to protect availability, but as consumer demand weakened, inventory began piling up. At the same time, CIC's commercial and service segments showed resilience. Commercial revenues rose 7% and service income grew an impressive 47%, boosting their share of group sales. Still, these areas often involve lengthy billing and payment cycles. Receivables jumped 46%, absorbing over 1.45 billion pesos more in working capital, further straining liquidity. About 1/4 of trade receivables were overdue at mid-year, with loss allowances and impairments rising, even as management expects most to be collected. The financial strain ran deeper inside CIC's factories. As production volumes declined, fixed costs like labor and maintenance were spread across fewer units, reducing gross margin from 31.9% to 30.2%. Cost inflation from peso depreciation and rising logistics further squeezed profits, barely offset by selective price hikes. Meanwhile, operating expenses increased 5%, dominated by higher personnel, shipping, and impairment costs. This created severe negative operating leverage. A 2% revenue decline translated into a 56% drop in operating income. Net income attributable to CIC shareholders collapsed 74%, as the company's profit increasingly came from operations with significant minority owners. Weaker earnings were accompanied by heavier cash outflows. Inventory and receivables absorbed nearly 1.9 billion pesos, while cash balances fell and short-term borrowing increased. The composition of current assets shifted: less cash, more tied up in inventory and receivables, leaving less liquidity for procurement and dividends. Additional blows came from foreign exchange losses and weaker contributions from associates. The result? Net income down 62%, and earnings per share down even more. Looking ahead, the test will not just be generating sales, but converting those sales into cash. For a turnaround, CIC needs inventory to move without discounting receivables to be collected swiftly, and factories running nearer to full capacity. Until then, CIC's first half results highlight a critical lesson for all investors. Revenue tells only part of the financial story. The true measure of performance lies beneath the headline numbers, in cash flow, asset quality, and operational resilience.